Hey everyone, my name is Daniel Choo. I'm the newest multi-asset portfolio manager at Betashares. I think Vinny Wadera wanted one of the ETF PMs. He's up at the back there to present this. But we thought managed accounts were really focused on client solutions. Your end clients want to define outcome, and we want to help improve the probability of reaching that. So today I'll be talking about managed accounts and how we can improve predictable income. So let's rewind a little bit. So it's March 2020. There's chaos on the streets, literally. And your global CIO calls you up from New York and asks you line by line, what's in your portfolio? You start with equities, that's the most volatile. Then you move to alternatives, we just talked about that. And then we start talking about Aussie fixed interest. And really what you want from Aussie fixed interest is something that's more predictable in terms of outcomes. So I'm going to be walking through one of our latest innovations. And again, we're innovating for the end client. So let's move on. So predictable income, and I'll be talking about 3 ETFs, but more importantly, talking about the managed accounts and how to use these ETFs. So just as a disclaimer, this is not for retail, but for advisors and financial professionals only. It's the first time I've actually read that out, but I have to at Betashares. But really, what I wanted to talk about today is how to look at defined income as a whole. Before I dive deeper into this, as Toby just mentioned, I just left Russell Investments. The gentleman who was sitting here, Alex Cruisley, I used to work 1 meter away from him for 13 years. And we always used to talk about dynamic asset allocation. Markets go up, markets go down. Donald Trump sends out a tweet and suddenly equity markets are down 3 or 4%. And we were using cycle, valuation, momentum, Betashares pretty similar as well, to look at investments. But wouldn't it be nice for maybe 20 or 30% of your portfolio, the fixed income part of your portfolio, to be more predictable? So you could spend more time on equities. Of course, you would have to assess credit risks from time to time, but wouldn't it be nice to have a more predictable outcome when it comes to income? So enter 28BB, 29BB, so on and so forth. Sounds a little bit like Star Wars characters or robots, but what these are really defined maturity ETFs. In order to get to the managed account part, which all of you are more interested in for end clients, we have to actually talk about what these ETFs are. And I really like to unpack the basket of corporate bonds that these ETFs hold. So let's take 2030BB. 2030BB has a target date of 31st of May, 2030. And in its DNA or methodology, we take the 12 months window before that, and we add all the different corporate bonds into a basket of ETFs. Why is this important? It has a defined maturity. You're going to be potentially buying these corporate bonds and holding them to maturity. And you're going to see predictable outcomes, which we're going to show later in the session. And so here you can see on the right-hand side, intentionally in very faint text, all the corporate bonds that this 30BB ETF holds, from ANZ, which matures in June 2029, all the way down to Woolies at the bottom right there. And so we hold an equal weighted number of corporate bonds, and it's currently yielding about 4.3%. That is about 1% higher than a 5-year term deposit. And if our ETF portfolio managers were here, this is definitely a target market in terms of term deposits and how we can substitute more predictable income. And so we collect this basket of corporate bonds. Again, very transparent, very easy to see what you're holding in terms of all the different corporate bonds that are here. So let's talk about one of the key attributes, very predictable monthly income. When we collect all of these 30 corporate bonds, we put them into a basket at the beginning of the launch of the ETF, and we can calculate a reasonable yield that this basket of bonds is likely to generate. So again, use 4% or 4.3% as an example, and we can divide monthly income every single month. So if you go onto our website, and I'm going to show you the calculator soon, you could see that this particular ETF, if you had $1 million invested in it, would generate about $3,500 of monthly income. Month in, month out, month in, month out. So when your global CIO does call you up, you can say what the predictable outcomes are. The other part of this is that if you look at this, you put an initial investment, you get the monthly income, and it's very likely, based on the number of defaults or lack of defaults, that you will get a similar amount of principal back at the end of it. And for those, there's a pop quiz. Out of the last 25 years, how many senior debt Aussie dollar denominated corporate bonds have defaulted? 0. Someone said 0. So 0. Of course, history is not an indicator for future performance, but that can tell you that based on an average A-rated basket of corporate bonds, it's a pretty low likelihood. The next key attribute, again, I'm going to get to the managed account side of things soon, but other key attribute that you should understand before we even talk about the solution itself is that it's liquid. Unlike term deposits, unlike annuities, you can't just go onto the ASX and sell it back to the market. But with these particular corporate bonds, you can sell them back to the market. So they are liquid. So if your clients are looking to rebalance, looking to invest in a house or what have you, then you can easily sell them. And so they are liquid. So again, predictable, but also liquid. Predictable, liquid. Those are the main things to focus on. To prove this, and I think someone talked about COVID-19, talked about the biggest sell-off in bonds in 2022. If you look at the chart that you see here, you can see that corporate bonds sold off by about 15% in that period of time. But if you were to hold this particular basket of corporate bonds that mature in 2023, you would see the outcome in orange. And this, of course, is a back test. It's a simulation, but you would see a predictable outcome. The starting yield of these corporate bonds was 3.2%, and the ending outcome was 3.2% or thereabouts. And so what this chart shows is that you didn't really need to worry too much about the credit risk. And the key reason for this is you're holding them to maturity. How many of us receive calls from our clients in 2022 asking, what has happened to my bonds? I thought these were safe. What happened to them? And we had to explain to them, if you hold them to maturity and there's no defaults, you're going to get back that return. But with a defined maturity basket of corporate bonds, you can really see that. The distinction between that, and this is maybe testing my explanation here, but the distinction between that and a broad basket of bonds is that there's always new bonds coming in, and so they're accumulating losses in an interest rate hiking environment. Whereas with these defined maturity bonds, you hold them to maturity, and effectively you got the choice to roll them. So it gives you more control. So hopefully that makes all sense. Again, very quick 10-minute update on what these actually are, and then we'll start talking about the managed accounts and how the end clients really benefit from these. As I mentioned, we have a calculator. With technology nowadays, our portfolio managers do everything. They not only run the funds, they even build calculators. But here you can see a calculator that's attached to the 2030 Defined Bond Income ETF webpage here. And you can chuck in an investment amount, say $100,000, and it will show you how much the monthly income is and what the projected yield is. And that's important, 4.3% net of fees when a 5-year term deposit is generating 3.3% and doesn't have any liquidity as well. So really, as I will talk about in the managed account solutions, these are liquid and predictable as well. The other thing you can do is hit the tab and go to target. And if you wanted a targeted amount of income, say $4,000, it would tell you that you would have to have $1.1 million in this sort of solution. So let's race into part 2. And as promised, talk more about the managed accounts. I can see many asset allocators here. I can see a lot of advisors here who use managed accounts. And really, again, it's about efficiencies. So let's start with case study number 1. This is a managed account with Aussie equities, global equities, listed infra, etc. And let's say, for example, you wanted more predictable outcomes in Aussie fixed interest. You could take out an Aussie fixed interest exposure and put them into a ladder. And that's a key word. We're going to see more innovation here in fixed income, a ladder set of ETFs or predictable maturities. And so when 28BB rolls around, it has a yield of 4%. When 29BB has a yield of 4.1 and 4.2 and so forth. When they mature, you have the choice to roll them or reinvest them back into equities. Again, more control, more predictability. And these are innovations that we've seen in the US for quite a number of years. In fact, bond ladders are some of the most fastest growing fixed income solutions in the US right now. And as you can expect, Betashares, out of all the defined outcome solutions in equities, fixed income, multi-asset, have chosen to go for fixed income defined maturity bonds. And so again, I think it's something to watch, something to note in terms of helping improve the probability of success. So the next case study I'm going to show is a targeted exposure. Well, many asset allocators here, and I won't put a survey in terms of show of hands, but imagine Trump runs for 2028. Just imagine that. Bannon's already talking about that. And so you could have a more targeted way of allocating fixed interests. Say, for example, you thought there was even a slight chance that Trump ran for VP or president in 2028. It'd be pretty crazy. But imagine that, and you wanted to hedge against that. You could set your maturity at 2028 to ensure that the chaos that is going to be the US presidential election in 2028, when credit spreads potentially increase, when inflation expectations increase, you could do something about that in 2028 and effectively roll your bonds and have the choice. You're not beholden to an index or methodology. You have more control over your fixed interests. So again, this is part of the reason why we're saying predictability in terms of outcomes, liquidity, and more control. So this is how you can get more targeted exposure. This is probably more on a DAA side of things, but essentially it's a play on what bond futures have been doing, or CDX, or iTraxx, or any of those. You can use these particular solutions to enhance the probability of more predictable outcomes. And that's the key part of that. Retirement and bucketing solutions. I think all of us have built bucketing solutions. We all know very large consultants right now that really are at the forefront of bucketing solutions. And let's talk about this scenario here. So you've got the long-term bucket on the left-hand side, and you've got the medium-term bucket and the short-term bucket. You can adapt and align your portfolio in terms of credit maturity based on the investment time horizon of your particular bucket. So if your long-term pool of assets is targeting 7 years, why not use a longer time horizon in terms of the maturity of your bond ETFs? And then when you look at medium term, which is a diversified pool of equities and fixed interests, you could blend something that matures in 29 or 2030. But I think the one that's more interesting is a shorter term pool. This tends to be a liquidity pool for your retirees who want to spend their money from day to day. And here you would look at something that has a shorter time frame. So normally that's 0 to 3 years. Well, we got something that matures in 2.5 years in 2028. And we've intentionally put in a 30% allocation. So cash would be something that helps you over 1 year. Short-term credit would be something that helps you over 2 years. And then the 2.5 year maturity corporate bonds would help you over 3 years. Again, being more adaptable, aligning the maturities in your portfolios. We think that's going to be something that's very unique for the Australian market. But again, it's been a wholesale use case in the US for quite a while. And then number 4, if Cam Gleeson was here, he's the head investment strategist at Betashares, who would talk about holding these particular solutions outside of SMA. That's why he hasn't been invited to this. We're talking more about managed accounts. But again, it's more of a solution when it comes to if your clients needed the money in 5 years or 3 years, and you knew that they needed $50,000 in this example, take it out of the SMA, put it into something that would have defined outcomes, higher probability of compared to a normal corporate bond, and be able to reap the income of about 4.3% net of fees. So again, this is one of the most popular use cases that we've been talking to clients about. But again, it's to improve retirement outcomes. This isn't about just the ETF. It's more about improving probability of success for all of your clients. Then finally, this is case study number 5. About half this room, I would guess, would have direct shares in their portfolios. There seems to be a love-hate. Some people love them, some people hate them. I've actually ran managed accounts with both of them. But if you wanted more transparency into a particular bond, you could invest in individual bonds, but that would be a bit of an operational nightmare. Or you can invest in these ETFs here, we would hold the corporate bonds from start to finish. And so they don't change. We don't roll them. We don't put in new bonds. It's the same bonds that are there on the day one all the way to maturity. And so if you wanted to build a report, if you wanted to build a portal, you would have the same ANZ, CBA, Woolies, what have you. And so that would be a very transparent way to look at a total portfolio, not only direct shares, but also bonds as well. So that's why we like these ETFs, in particular when it comes to transparency. Before I open up to questions, I'm sure there are quite a few, given that it's quite an innovative space. I just wanted to talk about the breadth of the fixed income solutions at Betashares. And so you can see that we're running about 20 or so different solutions here. And really, we're really focused on the defined income side of things. I think you're going to see a longer list of solutions when it comes to defined outcomes, not only in equities, but fixed income for managed accounts. So if you have feedback for us, we'd love to work with your clients to build out the right solutions for you, once again, to improve the probability of success. And so that's really what I have for you. If you want more information, reach out to Vinny or James here, who's come here. Actually, I know a lot of people here. Yeah, we'd love to talk to you about how we can help your clients.
Hi, just a little on the technical side. How do you deal with new flows into the fund over time? You're buying little pieces of all of these bonds at regular intervals as money comes in, or?
Yes. So let's go back. Let's go back to the corporate bond slide. So this one here. So when we start the portfolio, we start with an equal weighted number of bonds. This could be 50, it could be 20, it could be 40, depending on the issuance of that particular year. We will drift these weights away from equal weighted based on the opportunity set when it comes to liquidity and pricing as well. So there's a bit of active management in this, but it is at the heart of it, a very hold to maturity type portfolio. And part of the key reason for this is we're trying to minimize turnover. And so we're trying to be very smart. There's going to be redemptions and there's going to be applications on any given day. So we're trying to be smart in the way we read the flows of the market, as well as liquidity as well. So right now, one of these bonds is 4.5% and another one is 2.5%, but it doesn't deviate too far from 3%.
So I guess that gives rise to another question, which is as the credit characteristics of the underlying instruments kind of drifts apart. If somebody says, look, Bendigo's gone from whatever they are, double B to double B minus or something. How are you managing that kind of weighted average?
Yeah. So I asked the same question to our PM. So that's a beautiful part about being a multi-asset PM. I get to interrogate my own team. So really what happens there, say, for example, let's go more extreme. What happens if there's a default? What are we going to actually do? So it'll be a case-by-case example. We will essentially most likely hold it and try and recover the capital. So it really is, the objective is to hold to maturity and beyond, really, if they're in the case of a default. But as I mentioned before, there has been 0 out of 25 years in terms of defaults, and these are A-rated companies. But of course, there's a probability of default.
Right.